Hey guys, Pete here, HVAC Greatness. Know your numbers, they tell us. Know your numbers. What does that mean exactly, know your numbers? Well, I'll tell you what it should mean. It should mean that you know what it costs to do your business well enough that when you calculate your pricing for your services, it's done accurately and you know that the bills are getting paid and you can predict what your profitability is on each and every job. Here's I'm gonna cover 3 key points by the end of this video, right? And so by the end of this, I don't care if you're a one-man operation or if you're a bigger company, you're going to get the big picture. You're going to understand, okay? So knowing your numbers by what you sell means encompassing something called departmentalization. Departmentalization. So when you set your business up, you had 2 basic categories. Income, money that you made, the bills that you sent out that got paid, and expenses, buying all your equipment, your parts, paying the rent, paying your employees, all that stuff. Well, when you enter your data in your accounting software, let's say QuickBooks, if that's the way you enter it, the reporting that you're getting back is going to be what we call macro. You're going to know that the company made money this month or lost money this month. But you really won't know where it made money, right? Or where it lost money. So this requires departmentalization. And it really is just a matter of creating departments. When you do a change out, that sale goes in that department. When you buy the equipment for the change out, it goes in that department. So this is data entry for your accounting. Let me share with you a little spreadsheet that I share with the training that I do, but this should help you to understand. So this is set up for QuickBooks, and these are your accounting codes, but instead of just saying, hey, this is a sale, what if it was a demand service call? So I'm going to make this yellow. So when we got a repair ticket and we entered in that $500 repair, it would go into category 3030. Now that's a subset of 3,000 of sales. If it was a retrofit, a change out, maybe that would go into this category. Now they're still all part of sales, but you can actually run a report for your service calls, for your new construction, for your maintenance agreements, for accessory sales, and know how much money you made. Why? Well, when we go to buy the equipment for the retro, if you'll see here, we'll go down to cost of sales, this -60, and when we buy the equipment, it goes in its own category. So that the equipment here is counted against the sale here. And let's say that you had to get a piece of equipment for a repair for the service department for some reason, then that purchase would go against that department. And so what you end up with are reports that tell you the truth. It's really that easy. It's not the information in your computer, it's how you enter it that gives you accurate reporting. So step number 1 is we need to make sure that you're departmentalized in your accounting. Now that's going to help your sales, and that's going to help your purchases in dividing that up. But as we move into step 2, point number 2, what about your overhead? Who pays the rent? How much rent do we get the installation department to pay, and how much rent do we get the service department to pay? So we departmentalize that as well. I've got a little tool here I want to share with you that we use to do that. And let me minimize here. And so this is a little tool that I have developed. This is what I call my small HVAC business overhead and quota calculator. We'll talk about quotas here in a minute, but what we do is we sit down and one at a time, we put the rent in here. If we have office employees, our cell phones, uniforms, truck insurance, licenses, training, advertising, which we have a separate calculator for, and everything else, so that we come up with a total fixed overhead amount. It's just the bills to run the company. That's all overhead is. It's not that complicated. But what can be complicated is how much of this $156,000 for this is a small company, how much of that should we allot for the installation department to pay for, and how much for the service department to pay for? You can literally go through here and say, okay, I've got rent. I'm charging $1,000 a month. How much of that space do I have sitting with equipment in it for change outs? Well, me, I usually, I might put some duct materials and stuff like that, so I don't have a whole lot of room. Or maybe I do. Maybe that's about 40% of my space. And then the other 60%, let's say I do another 40% here in my service parts and stuff, and I've got about 20% of my space set aside for coil cleaners and all my maintenance stuff. So you can actually put another department if you want. But what it does is it takes these dollars and converts them to dollars here. And so by the time we add them all up, we want the installation department to pay $55,985 in overhead. And so we build that into our pricing. The service department has to pay more in this scenario. Now, in this scenario, that's not a typical company. So don't copy those numbers. We have to take your numbers and enter them in. You don't miss anything. And then we put them into the calculator. But there's a little bit more to this that I want to break out because, and this may be a good point to talk about item number 3, and that is the type of pricing that you're doing. When we start to move these percentages around, we come up with exact dollars on your overhead, okay? But the GP method doesn't use dollars. It calculates your prices based on percentages. So let me introduce that at this point right here. And I'm going to bring up this image here. So here's how gross profit actually works. What we do is we add up something called our COGS, cost of goods sold. Cost of goods sold. And what COGS are, it's all the stuff that goes into the actual, let's say, change out. You bought a piece of equipment, that's a COG. You bought supplies and duct transitions, all that went into the job as part of COGS. You have technicians or installers installing that, that's a COG. Subcontractor, that's a COG. The permit, everything that goes into the job is a cost of goods sold. It's what it costs you to do the job. And so what most companies are doing, they're using a percentage calculator, like 50%, and using that to price their service. Well, let me show you why that doesn't really work that well. Here's an example of a gross profit calculator. So if my COGS, I'll add up all my equipment, materials, and labor, and it cost me $5,000 to do it, I would divide that by my desired GP of 50%, and which would be $5,000, and would be a $10,000 job. Okay. Now the assumption is that your overhead, all those bills, the rent and stuff, they're actually a percentage of this, and they're in an estimated 30%, maybe 25%, depending on how you're set up, or even lighter, is going to go towards overhead. So we have on this change out, we'll call it a 2-man crew doing a change out, $3,000 to pay the overhead. Sounds good, right? Okay. The other $2,000, by the way, would be your net profit. Let's go to the next scenario, and let's take a job where the equipment, the COGS, was much more expensive, and you got to spend $10,000. Well, we use the same 50% GP, and suddenly we're charging $20,000 for that job. And so it's assuming an overhead of $6,000, 30%. So which is it? Are the bills, we got small, are the bills $3,000? Or are the bills $6,000? Here's another scenario. What if it goes the other way? What if you were just doing ductwork change for the day and you had two guys and you had all this ductwork and insulation, starting color, everything that you did, and it came up to $4,000. You use the GP method. Now you're going to sell that job for $8,000, 30%. Got to pay the bills, right? Or $1,600. Now, wait a minute. On one job, you have $1,600 to pay the bills with. On the other job, you have $6,000 to pay the bills with. And on the other job, you have $3,000 to pay the bills with. Can you see where this is a problem? It's a guess. Why not, just like we put exact dollars in the COGS? We know exactly what the equipment costs. We know exactly how much labor to put that job in, permits, subcontractors, if you have an electrician or a crane, special equipment. If you know that exact equipment, why not put the exact overhead in there instead of some percentage and then mark it up? Well, if you do that, when you add all of that together, you have what's called your break even. This is exactly to the dollar what I have to receive in order to break even, not lose money, not make money either, but I'm breaking even. And I take that number and mark it up of what's called net profit. By the way, gross profit is everything above direct costs. So that's the money you get to pay all the bills with. And once all the bills are paid, what's left over is net profit. Okay. In its simplest form, guys, I'm sorry for talking too simple for some of you, but everybody needs to get this or be reminded of this on some level. Okay. So now let's look at what we would do on how to price calculate this. So I'm going to go to, first of all, larger company. Let's say we've got the COGS, the materials, equipment of, and I just put a bunch of stuff in here, just some equipment, a pad, or whatever. So this is my job. I've got sales tax. I've got every possible expense in there. But check it out. My overhead burden is exactly $2,449.86. And my break even is this. Now, if I use the net profit method, let's say I'm shooting for 20%, this would give me a price of $11,819.80, but 82 cents. But what would have happened had I used the gross profit method? Let's see. Gross profit, and we use that 50%, I'd have charged a lot more money, $13,000, $13,444. And again, switching back to net profit, 11,008. Okay. I got financing fee. I got a sales commission in here. We've got sales tax on your stuff up here. Okay. So we've got all this stuff figured in, a commission rate, whatever that is, hourly pay, task pay, subcontractor. We've got every possible scenario. This is why you'll want to do net profit pricing. Guys, we are in tougher times. It's going to get competitive. You can't guess at this anymore. Get dialed in, know exactly what your overhead is by department. Let me show you that real quick. First of all, let's compare a one-man operation, because maybe this company here, let me go back, and it's based on a company that's about $5 million in revenues and about $1.5 million in overhead. Well, Pete, I'm just a one-man trucker. I just have 2 employees. What about me? So it's the same thing. Here's the price, same price calculator. Now I've got a different equipment amount, but it doesn't matter. It's the same principle. We're using something called task pay, but the overhead is what we're looking at. The overhead on this per day isn't 2,300, or what was it? $2,449. The overhead for this little company is $1,219. And so we have a different break even, right? And so all of that depends on their information. So this is a really small company, $600,000, $114,000 worth of overhead. That's about 19%. So really light overhead. And they have allotted all of their overhead, $114,000, which, by the way, we calculate over here. Okay. And they have split that up based on how much work they have in changeouts, how much work they have in service. And even in this case, on the new calculator, we have the ability to calculate how much work you have in preventive maintenance. So if you have your maintenance agreements down here in this yellow, and I know this is an eye chart, but we even down here in the dark blue have something for calculating special projects and things like that. That's the way you do it. Now, if you look at the true overhead costs for different departments, what you're going to find is that the service department requires a lot more support. You got people on the phone calling the customers. There's more invoices to bill. There's more coordinating that has to take place. Your service technicians require more support than a two-man change out that's over on a job, on one job today, changing out an entire system. There was some coordination set up to get that going, but a lot of that's covered by your salesperson if you have one. Okay. My point is that just because the service department has more overhead and the installation company has less doesn't necessarily mean that you apply them directly. Using tools like this, what you can do is look at what the market will bear. Okay. Because if you look at what it truly costs you to do service and what your true production time, billable time, like how many service calls you're actually working on throughout the year, what that is and how much you have to pay the technician and all the bill, it's expensive. Service is expensive. So what a lot of companies do is they offload some of that overhead and they stick it over in the changeout department and allow the changeout department to carry that. Why? Because they can. Because you can make greater margins in that department than you can in the repair department. Does that make sense? And in maintenance, if you're competitive with the maintenance agreements out there at $25 a month or $300 a year to do 2 visits per year, you're going to find out that you don't want to add too much overhead or you're going to be losing money on that. The overhead for that may need to be alleviated a little bit from some of these other departments. Now, the alternative to that is you can skinny everything down, combine and blend and say, listen, here's my overhead per man hour. This is what I'm going to charge no matter what I'm doing. But you got to be careful there. You don't want to do that. The reason you don't want to do that is you're going to find that you're out of whack with everybody else's prices. You're going to be way too high in certain areas and selling yourself too cheap in other areas. So these are the things that we need to consider. And I have one last element, but we need to be departmentalized, right, by department in your expenses and sales, as well as your overhead. Divvy that up, right, among departments. Then you need to use net profit pricing instead of gross profit. Net profit means you know exactly to the dollar amount what your overhead is per job and not some guessing percentage that could, at the end of the sale, deliver you a loss of money on that job or price you out of the job completely because you're using this percentage and somebody who knows the net profit is going to come in, scoop that out from under you and make money, your money, because you didn't know your numbers. So the other piece I wanted to talk about is what we call capacity. So the way this works is really simple. We take all of the bills, we divide them up by how many units sold, how many service calls can we consistently count on each month and set a quota for. Okay. And we want to be smart about this. There's a lot of moving parts, I know, but in its simplified form, how many change outs will we get this year? And how that means we divide our overhead up into every single change out. And that's how we get an exact dollar amount. Let me show you what that looks like. And so if we look at this, in this particular company, we have 4 installers. Their overhead allocation is here. Of that $1.5 million, they're going to be paying 55% of that bill. So what we do is we divide that up by how many, what we call production hours. And a production hour means that, yeah, we're paying them 2,080 hours, but there's 40 hours a year that we're giving them vacation. There's 40 hours a year we're giving them um, uh, paid holidays, and we're assuming that of these 2,000 hours left over, they're about 70% billable, 1,400 hours. Now that's about 175 work days. Okay, split up between these two-man crews, and we do this. We do a similar thing for this section, which is their labor. Right, if we're going to pay $50 an hour to the lead man and $30 to the helper, that's $80. Well, we got to add some burden on there because we're giving them benefits. We're paying their vacation. We're matching their Social Security. And so we have to divvy this number up across those hours. And then we come up with what's called a crew hour for our labor and a man hour. So that's how that works. But we got to have some projections. So way back over here in this tool on your one-man operations, we look at this. We say, well, how many service calls can we set as a quota? How many changeouts per month? How many accessory sales per month? How many hourly billings do we have maybe in commercial? So we figure all of that up, and we can figure out how to make your draw, how much of your money is actually coming out of the work you do in the field. And then the company's overhead is going to have to pay the rest of your salary. So we ultimately come up with a quota. We plug this quota in over a period of a year, January, February, March, being realistic. And then we look, well, how many of those calls are we going to have to go advertise and buy? Right? And sometimes throughout the year, these numbers will surprise you. 143 purchased leads and service calls at $300 a piece, depending on where you get your leads from, is $42,900. That's a lot of money. And if you have something like over here, SEO for your website, you should, and you add that in, you may have a $60,000 worth of advertising expense. That's where these numbers are coming from over here. Didn't automatically plug in on this one, but you see that. So these are fixed overhead. And then when you have that budget, things get slow. You can advertise and hit your quota. Now, these other areas we go through, well, we'll mention this. These are all part of direct field labor. Okay, so your workers' comp, the benefits for them, matching their taxes and their field wages. Some people just do payroll. Well, office staff is separate when we come into figuring our pricing. And then we have something called variable overhead, variable expensive. That's all the automotive. So when we take your gasoline and your parking and your maintenance and repairs, tolls, whatever you have, we like to break that out from the fixed overhead so that as you're busier, those numbers are recuperated faster and you infuse that quickly into your cash flow so you can pay for gasoline when you need it, right? Not have it stretched out through the year. So these are the key elements. Now let me kind of recoup best I can remember. You know me, I'm old. So we got departmentalization. You don't want just income and expenses. We need to know what kind of income. Is it for a service call, a change out? Is it for a maintenance visit? Is it for your commercial work, refrigeration? So we can break little departments out. It doesn't have to be complicated. It just needs to be divvied up so that when you run your report, you can see where you're making money and how much, where you're losing money and how much, and you can step up and fix it. And you do it before things get out of control. Now, if you departmentalize your expenses and income, don't forget to departmentalize your overhead. That's typically not broken up. That's all lumped into one. And that's why they come up with this 30% overhead. That's a blend, by the way. That's across the whole company. So we have to actually look at who's using what and how we want to allocate, which department we want to charge that money to and how much, based on a couple things. How much money they consume and how much value the service brings in terms of dollars and cents, what the market will bear. I mean, can I really charge what it's costing me, or do I have to be a little lighter to be competitive and make the money up over here in this department. You absolutely should consider that. So we got the overhead. We're going to allocate, departmentalize all of that. And then we're going to be careful of figuring our overhead with a percentage, because you can't pay bills with percentages. You need dollars. So we convert that to actual dollars. How do we do that? By predicting how much work we're going to do. If we know we're going to do one-man operation, 35 service calls, so 40 service calls per month, because I'm a little guy, then what we need to do is take your overhead and break it up into those and hold yourself accountable for the quota. And so, you know how many service calls you have to generate this month, this week, today, whatever. And we have a budget built in there, because it's built in your overhead, that you can pay to advertise to get that work in when you don't have it. And guess what? If it turns out you're doing a really good job and you get a lot of referrals and you're getting this work organically, that money actually converts to net profit. So you're okay if you don't spend the money. Where you're not okay is where you go over. Now, one of the biggest things that are difficult to control is labor. We do that very carefully in our net profit pricing program, because what happens is when you're allocating, you're figuring so many jobs and you're paying this person so much money, but you really haven't calculated, are we charging enough within each job to make sure they're paid for their downtime, right? The time that you have them in the shop sweeping the floor, or sitting in a training class somewhere, or even on vacation and holidays, right? So it's not a good time to be sending employees home. They're just too valuable, and we want to keep them around. So we want to keep them productive, efficient, happy, and taken care of. So I think I covered everything. If I forgot anything, hit me up, and I'll cover it again later. But I wanted to have this conversation because, guys, times are getting tough. There's certain things that are going to change in the way we interact with our customers. And talking about the money, which we've typically avoided, I think we need to become a little bit more transparent about that, at least with certain clients. People are valuing their money, and they're very slow to let it go. They'll make the right investment if you can build the value, your HVAC greatness. That's your branding and your marketing and your positioning. But then you have to charge the right amount as well, so that not only the bills get paid, but you make a profit. I mean, you're at high risk. You deserve the gain of taking that risk, right? Risk and gain. And so we want you to be profitable. But by the same token, your customers, they want a fair deal. They don't want a good deal. Good customers don't want a good deal that's going to put you out of business. They want a good deal where you're happy and you can pay your bills, and they know that they got a good purchase and made a wise investment. And having this type of information is invaluable if you ever have to have that negotiation conversation. And I predict that we're going to be having that pretty often as times move forward in this difficult, struggling economy. Hopefully the time will come in the near future, not too distant future, where that'll turn back around. Guys, the good old days, everything that they've taught us up into now, they worked. This, you can do what I did too, is not true. You don't live in their market where they had success. You don't live in the year they had their business when they started their business. You live in today's time, under today's conditions, in your local market, and those things need to be analyzed and critically broken down to the point where you know exactly where you need to be in terms of money. And yes, you can still scale, you can still grow. There's certain things that are always going to be a part of that. And that's a good strategy, a good foundation. But I hope this helped with the pricing. I've been wanting to put this out for a little bit, but I've been so busy with the branding stuff that sometimes I get a little distracted. But feel free to make any comments. Let me know if there's anything that you want to hear in the future. And I appreciate you, those of you who stuck around this long. How you doing? So Pete Ramsey here, HVAC Greatness. Need any help? Reach out. That's what I'm here for. Bye-bye.